So if you owned a security that promised a fixed dividend, ranked ahead of common stock, and felt, almost bond-like in its structure, would you assume your money was protected?
I mean, most investors hear the word preferred and they immediately stop asking questions. The label itself just does the heavy lifting.
Right, it really does.
It implies priority, and it implies a sense of institutional safety and strict discipline. But if we look at the foundational principles of security analysis, specifically the frameworks built by investors like Graham and Dodd, they reject the label entirely.
Totally.
They demand answers to much harder questions, like preferred by whom, protected by what specific mechanism, and, when things inevitably go wrong, enforced by which people.
Welcome to Capital Allocation Lab, where we teach disciplined long-term investing by revisiting classic books and core ideas explained clearly in today's context. Our goal is simple: help fundamentals-minded investors improve judgment, not chase tips, forecasts, or trading signals.
Today's deep dive is into preferred stock protective provisions and the maintenance of junior capital. The central focus is the reality that any investor's claim is only as safe as the capital sitting beneath it, really.
Before we begin, please subscribe and like to support more educational episodes.
And as a reminder, this is educational content only. It is not individualized investment, legal, tax, or accounting advice.
So the phrase preferred stock is basically a psychological trap. You say it out loud and it just sounds inherently senior, right?
Oh, absolutely. It sounds like an investment that sits comfortably in this, Goldilocks zone between the chaotic volatility of common stock and the low returns of a traditional bond.
Yeah, exactly. You get a fixed dividend, which sounds predictable, and you supposedly have priority over the common stockholders if the company's assets are ever liquidated.
Right. It's designed to appeal to that exact psychology. It targets the investor who wants income but still craves the comfort of being near the front of the line.
But the critical weakness, and we have to emphasize this, is that it completely lacks the contractual force of a true bond.
Yes. I mean, if you hold a corporate bond, the company has an ironclad legal obligation to pay your interest. If they miss that payment, specific aggressive default provisions instantly activate.
You have a legal lever you can pull.
Exactly. A lever which can force the company into bankruptcy or restructuring. But preferred stock doesn't have that lever.
No, it doesn't. The dividends are almost always at the discretion of the board of directors. So even if the prospectus says the dividend is cumulative, meaning the unpaid amounts keep adding up on a ledger, the board still holds the ultimate authority.
Right. They decide when or even if they will actually part with the cash. You are entirely dependent on their timeline.
Which is why the concept of priority has to be completely redefined in the mind of the investor. Priority is not a feeling of safety.
No, it's not a feeling at all. Priority is a written, specific, and legally enforceable structure. Without ironclad protective provisions, you're essentially just hoping that the management team and the common stockholders decide to treat you fairly.
Which, out of the goodness of their hearts, right?
Yeah, good luck with that.
So let's visualize the capital stack for a second. Think about a normal corporation. You have creditors at the very top.
Right, the banks and the secured bondholders.
Exactly, they get paid first.
Mm-hmm.
Then at the very bottom, you have the common stock.
Yeah.
They absorb the very first losses if the business struggles, but they also capture all the unlimited upside if the business scales.
And right there in the middle is the preferred stock.
Yeah.
Sitting in the meat is an incredibly vulnerable place to be. You do not have the unlimited upside of the residual owners, but you also lack the strict contractual enforcement rights of the senior lenders.
There's a brilliant analogy from the text that captures this perfectly. Imagine you are standing second in a very long line.
Okay, I'm picturing it.
You feel secure, right? You know exactly who is in front of you, and you know there are dozens of people behind you. But owning preferred stock without strong protective provisions is like standing second in that line, only to watch the management team walk over and let an entire new group of people step directly in front of you.
Wow. Yeah, that's brutal. Your physical position hasn't moved, but your economic priority has just been severely diluted.
Exactly.
And that feeling of being shoved backward in line is precisely why preferred stock requires strict provisions regarding the issuance of new senior securities. A robust charter must explicitly state that the company cannot issue any prior preferred stock, or create a new mortgage bond without formal approval.
And not just any approval, right?
Yeah.
It needs the formal approval of a supermajority of the current preferred holders.
Exactly. The math on that supermajority is critical. We are not talking about a simple 51% majority where management might just need to sway a few large institutional holders to get their way.
Right, it's much higher.
Historically, these provisions demand 2/3 or even 3/4 of the preferred holders to vote in favor. The fundamental logic is that the specific class of investors whose position in line is about to be downgraded must give their explicit, overwhelming consent.
I do have to push back on that requirement a bit, though. I mean, if a company is in severe financial distress and desperately needs to raise capital to survive, doesn't requiring a 3/4 supermajority vote completely paralyze the business?
That's a common argument.
Like, you're essentially giving a scattered group of investors the power to hold the entire company hostage.
Management teams argue that exact point all the time, you know? They claim these covenants create fatal rigidity, but protection is not the same thing as paralysis.
Okay, how so?
Well, the goal of the covenant isn't to build an impenetrable brick wall that prevents the company from ever raising another dollar. The goal is simply to force management to the negotiating table.
Oh, I see.
In a true bankruptcy rescue scenario, if a new senior bond issue is the absolute only way to keep the business alive, those preferred holders might look at the grim reality and rationally vote yes.
Right, because the alternative is watching the company liquidate and losing everything.
Exactly. They will consent to being pushed down the stack to avoid losing their entire principal. The covenant just ensures they cannot be pushed down the stack quietly, in the dark, without their explicit consent.
So as an investor reading a prospectus, the question isn't, can this company raise more money? Because every business needs to raise money.
Right.
The real question is, can this management team raise money in a way that structurally subordinates my claim without asking for my permission?
And that distinction uncovers one of the most glaring historical loopholes in corporate finance. It's a flaw that Graham and Dodd heavily critiqued.
Tell me about the loophole.
Historically, you would see preferred stock provisions drafted to fiercely protect the investor against the issuance of secured debt. The charter would explicitly forbid management from taking out a new mortgage bond on a factory without a supermajority vote.
Sounds good so far.
But those same documents would remain completely silent on the issuance of unsecured debt, like massive debentures or long-term promissory notes.
Let me stop you right there, because I think the distinction between secured and unsecured debt trips a lot of people up.
Yeah, it does.
If I'm an investor and management is prohibited from placing a mortgage on the factory, why should I care if they issue a massive unsecured note?
Right.
I mean, that new unsecured debt isn't tied to the factory. It isn't tied to any specific physical collateral. So my preferred claim on the overall business should still be fine, right?
That is exactly the legal illusion the drafters of those old covenants relied on. From a strict legal standpoint, an unsecured debenture doesn't place a lien on a specific piece of machinery or a specific building. But from an economic standpoint, the distinction is entirely illogical. The danger to the preferred stockholder is not just that a building is being pledged as collateral.
What's the real danger then?
The ultimate danger is that a massive new senior claim on the company's daily cash flow has just been created.
Ah, because interest payments on debt, any debt, secured or unsecured, must legally be paid before a single dollar of preferred dividends can be distributed.
Precisely. If management issues $50 million in unsecured debentures, that debt is going to act like a giant sponge.
A sponge, I like that.
Yeah, it absorbs the company's operating cash to satisfy its interest obligations. By the time the cash flow trickles down the stack to where the preferred stockholders are sitting, the bucket might be completely dry.
Wow.
A massive unsecured obligation threatens your preferred dividend just as violently as a mortgage bond does.
Which means a covenant that strictly bans new mortgages but allows unlimited unsecured debentures is essentially a useless protection.
Totally useless.
It's like locking the front door but leaving the entire back wall of the house wide open.
That's exactly what it is. There is, however, a very practical reason why that loophole originally evolved.
Which is?
No business can function if it has to call a special shareholder vote every time it needs to borrow money to meet short-term payroll or stock seasonal inventory.
That would be a nightmare.
Companies absolutely require the flexibility to engage in ordinary day-to-day bank borrowing.
So how does an investor balance that? You want to give the business the oxygen it needs to operate, but you cannot allow them to issue long-term structural debt that sits ahead of you.
The structural remedy is to write a specific carve-out for ordinary course borrowing. A properly written provision will explicitly permit short-term bank loans.
Like defining them by a strict maturity limit.
Exactly. Say debt maturing in less than 1 year. Or they might cap them at a very specific dollar amount tied to inventory.
Makes sense.
But it will strictly require a preferred holder's supermajority vote for any longer-term bonds, notes, or major debt claims. And that's regardless of whether they are secured by hard assets or completely unsecured.
So my direct advice to you, the listener, is this. When you are reading a financial document, your eyes cannot just gloss over the word debt.
Never.
You have to interrogate the definition. What is the maximum size? What is the maturity? What is the priority?
And perhaps most crucially, what are the exceptions?
Yes. The exceptions are where all the actual risk is buried. A company can write a beautifully strict rule in Section A and then completely dismantle it with a vague exception in Section B.
And issuing new debt isn't the only way management can fundamentally alter your risk profile. We really have to look at how a board of directors can pressure preferred holders through structural balance sheet maneuvers.
Oh, this brings us into the mechanics of recapitalization tactics, right?
Yes, the recapitalization pressure cooker. Picture a company that has fallen on hard times. They have a cumulative preferred stock outstanding, and because business has been terrible, they have skipped the dividend for 3 straight years.
Ouch. So those unpaid dividends are now massive arrears.
Right. They sit there as a heavy, looming obligation. But eventually, the business starts to recover. Management wants to clean up the balance sheet, usually because they want to legally resume paying dividends to themselves, the common stockholders.
Naturally.
So they introduce a recapitalization plan. They come to the preferred holders and offer an exchange.
What's the pitch?
They say, give us back your old preferred stock and officially surrender your legal claim to all those accumulated back dividends. In exchange, we will issue you a brand new preferred stock, and maybe we'll throw in a fraction of common stock to sweeten the deal.
Depending on the exact mathematics of the offer and, the true earnings power of the recovering business, an exchange like that might occasionally make sense.
Sure, occasionally. But Graham and Dodd point out a highly coercive pressure tactic quietly embedded in these recapitalizations.
And what's that?
Management doesn't just offer the new security. They often design that new preferred stock to sit equal to, or even strictly senior to, the old preferred stock in the capital stack.
Wow. That turns the protection into an absolute weapon.
It really does.
If you are a principled investor holding the old preferred stock and you decide to vote no because you want your back dividends, you are suddenly placed in an agonizing position.
Exactly.
Because if the majority of the other holders vote yes and take the exchange, they all migrate into this new senior security. You are left behind, holding an old security that has just been structurally subordinated.
The people who took the deal just stepped right in front of you in the priority line.
That's incredibly coercive. The investor is left with a terrible choice. Accept a haircut on the dividends you are rightfully owed, or stand your ground and watch your priority position get decimated.
It forces you to question whether a vote in a recapitalization scenario represents genuine, willing consent from the investor class, or, if it is merely a product of structural coercion.
It really forces you to ask, who is actually benefiting from this cleanup? Is this new package of securities genuinely designed to preserve the economic value of the preferred claim?
Right.
Or is it a maneuver designed solely to clear the runway so the common stockholders can start enriching themselves again?
And this vulnerability is exactly why structural disciplines like sinking funds are so vital to explore.
I mean, a sinking fund sounds like a piece of archaic financial plumbing, honestly.
It does sound old-fashioned, but the concept is profoundly important. At its core, a sinking fund is simply a mechanical requirement forcing the company to gradually retire a portion of the security over time.
Or to explicitly lock away cash for that exact purpose, right?
Exactly. We see this mechanism constantly with standard corporate bonds. If a company borrows $100 million due in 20 years, just letting that massive obligation sit untouched for 2 decades is incredibly risky for the lender.
Yeah, because the company might reach year 20 and simply not have the cash to pay off the lump sum.
Precisely. A sinking fund forces the company to actively pay down a fraction of that principal every single year, systematically de-risking the loan.
And because preferred stock intrinsically has weaker contractual rights than a bond, having a mandatory sinking fund is arguably even more essential for a preferred holder.
I would completely agree with that. Historically, these covenants might require the company to retire roughly 3% of the outstanding preferred stock every year.
3%, okay.
Or sometimes it would be tied to a specific percentage of the annual profits. It forces management to actively shrink the senior claim, reminding them that this capital is not a permanent free resource that they can just ignore.
But the mere existence of a sinking fund on page 1 of a prospectus is not a guarantee of safety, is it?
No, absolutely not. Graham and Dodd offer a severe warning against surface-level reading. You have to read the conditional triggers. A sinking fund is only as strong as the conditions that mandate its payment.
Right, the fair weather sinking fund. You might read the fine print and discover that the company is only required to make the sinking fund payment if all the preferred dividends for that year have already been paid in full.
Yes.
And only if the board of directors determines there are sufficient surplus profits remaining.
Think about the practical reality of those conditions. The very moment the business enters a severe recession, profits will evaporate. The board will pause the dividends.
And automatically, the requirement to fund the sinking fund entirely vanishes.
Poof, gone. The discipline disappears at the exact moment the investor is facing the highest risk and needs that discipline the most. It is an illusion of protection.
Which means you must scrutinize the exact mechanical triggers. And a related, equally important discipline is a covenant requiring the maintenance of working capital, or net current assets.
Yes, you frequently see provisions demanding that the company maintain net current assets equal to a specific percentage of the preferred issue, or a percentage of the preferred stock and bonds combined.
Now, net current assets essentially represent the company's immediate liquidity cushion.
Right, exactly. It is the cash, the short-term receivables, and the inventory, minus all the short-term liabilities.
While it doesn't tell you everything about the long-term franchise value of the business, it provides hard, tangible proof that the company isn't operating on the absolute brink of insolvency. It guarantees a margin of breathing room.
But the critical question is always, what happens when the test has failed? What if the company's liquidity cushion drops below that required percentage?
Right. A covenant is completely worthless if it lacks a practical, painful remedy.
Absolutely. If the working capital test fails, what is the consequence? Does the company simply have to pause common stock dividends?
I mean, that is a very weak remedy. If working capital is that low, they probably shouldn't be paying common dividends anyway.
Exactly. In a truly strong structure, failing that net current asset test should trigger a massive shift in voting control directly to the preferred holders.
You really have to apply a rigorous test to any covenant you read. What precise metric is being tested? How frequently is it measured?
And what is the specific enforceable penalty when management breaches it?
That brings us nicely to the ultimate remedy. Governance. When the financial promises are broken, who gets to steer the ship?
This is huge. We have to look closely at voting rights, particularly after the non-payment of preferred dividends.
To really understand this, we first have to clearly separate cumulative preferred stock from non-cumulative preferred stock.
Okay, lay it out.
With a cumulative issue, if the company hits a rough quarter and skips your dividend, that money is not forgotten. It accumulates on the balance sheet as an arrearage.
Right.
And the strict rule is that the common stockholders cannot receive a single dime in dividends until every last penny of your accumulated arrears is paid out.
Non-cumulative preferred stock is a completely different reality. If the board skips your dividend this quarter, that money simply vaporizes.
Wow, just gone.
You have zero legal right to ever claim that specific missed payment in the future. The loss is absolute and permanent.
Given that reality, you would intuitively think that non-cumulative preferred holders would be granted the absolute strongest governance protections.
You would think so.
If they miss a payment, they suffer permanent economic damage. Their need to step in, fire management, and stop the bleeding is immediate.
Yet Graham and Dodd observed that historical voting protections actually favored cumulative issues. They completely rejected this logic.
They did.
Yes. They argued forcefully that non-cumulative holders are vastly more vulnerable and therefore require vastly stronger, faster governance rights, precisely because they lack the ability to recover their losses in the future.
That makes total sense. So when a dividend is missed, what do these voting rights actually look like in the wild?
They come in several different shapes. The preferred holders might be granted the sole right to elect the entire board.
Okay, that's powerful.
Or they might get the right to elect a simple majority of the board. They might only get to elect a minority, giving them a few seats at the table. Or they might just be granted the right to vote share for share alongside the common stock.
Oh, that final variation share-for-share voting is a mathematical trap that catches a lot of unwary investors.
It really is. A charter might say that upon a missed dividend, the preferred stockholders gain the right to vote share for share with the common. That sounds entirely democratic. It sounds fair.
But think about the ratios. If a company has issued 10 million shares of common stock and only 100,000 shares of preferred stock, a share-for-share vote provides absolutely zero practical power.
Exactly right. The preferred holders will be overwhelmingly outvoted on every single issue. They have a theoretical right to vote, but mathematically they have no voice.
Conversely, if the capital structure is inverted and the preferred issue is massive while the common share count is tiny, that exact same share-for-share legal phrasing could hand absolute control of the company to the preferred holders.
Yes. The identical legal text can result in complete impotence or absolute dominance, entirely dependent on the specific mathematical architecture of the capital structure.
The timing of when these rights trigger is just as crucial as the math, too. Some charters say the voting right appears after a single missed quarterly dividend.
Others require 4 missed quarters, or even 8. Historically, the standard custom was roughly 1 year, so 4 missed quarters. But you can never assume custom applies to the specific document you are reading.
And the timing creates a delicate policy balance, right? If the covenant requires 8 missed quarters before voting control shifts, the preferred holders are essentially being locked in the trunk of the car for 2 full years while management drives it off a cliff.
That is a terrifying thought.
By the time they finally gain access to the steering wheel, the core value of the business might be entirely destroyed.
But if the trigger is too sensitive, say control shifts after just 1 missed payment, it might be overly punitive. A fundamentally sound business might hit a brief 1-quarter cash crunch due to a supply chain issue.
Right. Forcing a massive change in board control over a minor temporary hiccup could actually damage the long-term value of the company for everyone.
Graham and Dodd deeply understood this tension. They introduced the principle of balance. Their goal was never revenge.
That's a good way to put it.
They recognized that the common stock is the residual owner, and therefore, under normal, healthy conditions, the common stockholders should elect the majority of the board and dictate the strategy.
But the moment the preferred dividend is not paid in full, that dynamic must immediately invert. The specific class of capital that is actively suffering the immediate financial impairment must take control of the decisions.
Exactly. The preferred holders should gain the right to elect the majority of the board. Crucially, however, they argued that the common stockholders should not be completely expelled from the boardroom.
Why not?
The common stock should retain the right to elect a minority of the directors. This prevents a scenario where the preferred holders, having seized absolute control, decide to intentionally delay paying off their own back dividends just so they can hoard voting control of the company indefinitely.
Oh, wow. I wouldn't have even thought of that.
Every class needs representation, but the majority power must rest with the class currently bearing the breach of contract.
And that logic leads directly to the threefold remedy.
Uh,
Graham and Dodd insisted that this shift in voting control shouldn't only happen when a dividend is missed.
Right.
It must also trigger if the company defaults on its sinking fund obligation, or if it fails to maintain the required working capital cushion.
If you rely on multiple distinct promises to keep your investment safe, the enforcement remedy must activate the moment any of those promises are broken.
Exactly. Because if control only shifted upon a missed dividend, management could just prioritize paying the dividend while entirely ignoring the sinking fund.
Yeah, technically keeping their boardroom seats while the underlying structural risk to the investor explodes.
Now, a completely valid pushback here is, does any of this legal theory actually matter in the real world?
A very fair question.
What if the preferred holders are scattered across thousands of retail brokerage accounts, completely unorganized, passive, and, poorly advised? Having a right on a piece of paper doesn't magically fix the company.
Graham and Dodd approach this with clear-eyed realism. A legal right that goes unused is worthless. A right used incompetently can cause chaos.
True.
But the potential that a right might be used poorly by scattered investors is not a valid argument against demanding that the right exist in the first place.
That's a great point.
If common stockholders elect a terrible board of directors, the solution isn't to permanently strip them of their right to vote. The solution is better organization, better education, and demanding higher quality independent representation.
This tension between theoretical rights and practical outcomes is perfectly captured in the Maytag case from the late 1920s. This is one of the most vital historical lessons in the entire analysis.
Walk us through it.
So in the late 1920s, the Maytag company undergoes a major recapitalization. The new structure features a first preferred stock, a second preferred stock, and the traditional common stock.
Okay, pretty standard so far.
The preferred shares are taken by investment bankers, the issuing houses, and sold off to the general investing public. Meanwhile, the Maytag family retains their tight control over the business by holding on to the common stock.
The preferred stock they sold to the public included a very specific written governance protection. The charter explicitly ruled that if the company missed 4 quarterly dividends, the preferred holders, acting together, would legally gain the right to elect a majority of the board of directors.
But then the inevitable happens. The business struggles and the dividends are completely omitted on both classes of the preferred stock. The 4-quarter trigger is tripped.
So, by the absolute letter of corporate law, voting control of the Maytag company legally passed from the common stockholders to the preferred stockholders.
The preferred holders officially had the power to clean house.
But the practical reality of the Maytag case is devastating. That legal control was never meaningfully exercised.
Why not?
The board of directors remained entirely dominated by the existing operating officials and individuals who were deeply personally aligned with the common stock ownership.
So the protection existed in ink, but it failed spectacularly in the physical boardroom.
Exactly. The preferred holders possessed the right, but they lacked the organization to use it. No one stood up, gathered the proxies, nominated a slate of truly independent directors, and fought for the impaired interests of the preferred class.
The lesson for a modern investor reading an offering document is profound. You cannot just read the trigger and feel safe. You have to ask the mechanical questions.
Yes. When the crisis arrives, who is actually going to organize the scattered holders? Who will identify and nominate alternative directors?
Right, who will absorb the significant legal and mailing costs to solicit the proxies? Who possesses the actual economic incentive to stand up and initiate a fight?
Graham and Dodd placed a heavy moral burden directly on the issuing houses, the investment bankers who originally sold the securities.
Interesting.
If an investment bank collects massive fees to underwrite and market a preferred stock to the public, touting its safety and its covenants, they have a professional duty to help those scattered investors organize and enforce those covenants when the trigger event occurs.
In a scenario like Maytag, the issuing house should have immediately stepped up. They should have obtained the registry of preferred holders, mailed out letters clearly explaining that voting control had shifted, recommended a slate of highly qualified independent directors, and actively solicited the proxies required to install them.
And the word independent is doing a lot of heavy lifting there. Those new directors cannot just be golf buddies of the current management.
Definitely not.
They must be genuinely independent of the common stock's influence. Ideally, they should have massive skin in the game, owning significant amounts of the preferred shares themselves, ensuring their personal financial incentives are perfectly mathematically aligned with the class they represent.
And we have to clarify a vital point here. The issue in cases like Maytag is rarely whether the current operating management are good people or capable factory managers.
Right. They might be incredibly talented at building washing machines. That is entirely beside the point.
What is the point then?
The point is a foundational governance principle. Decisions affecting a senior class of capital that is facing impairment must be made by capital allocators who are directly accountable to that specific class.
If you are listening today, the ghost of the Maytag case applies to almost everything you invest in. It applies to modern creditor committees, bondholder groups, private credit covenants, minority shareholder rights, and how you view proxy voting.
Absolutely. You must always ask, when the storm finally hits, is there a functional, real-world mechanism for the owners of the affected claim to band together and assert their power?
Because if no one has the incentive or the mechanism to organize, that beautiful legal protection you relied on is nothing more than decorative text in a dusty filing.
Let's shift our focus to the second major theme of this deep dive. It is a concept that is mathematically foundational to everything we've discussed, yet it is constantly overlooked by casual investors: the maintenance of junior capital.
Oh, this is so important. If you want to deeply understand any fixed value investment, whether that is a corporate bond, a preferred stock, or a modern private credit loan, This is the most important concept to master.
It really is.
Your safety as a senior security holder depends entirely on the presence of a massive layer of common equity sitting beneath you in the capital stack. That junior capital is the physical mathematical cushion that absorbs all the financial losses before your senior claim ever takes a scratch.
The lending analogy here is perfect. Think about a bank lending money to someone buying a piece of commercial real estate.
Okay.
If the bank lends you $2 million, they absolutely do not want the property to be worth exactly $2 million. They want the borrower to have made a massive down payment. They want the total property value to be substantially higher. Because if the local real estate market crashes and property values drop by 20%, the borrower's equity takes the first hit. The borrower loses their down payment, but the bank's $2 million loan remains perfectly intact. The junior capital absorbed the blow.
Corporate structures rely on that exact same mechanical logic. A bondholder or a preferred stockholder should never lend money to a business at a modest fixed interest rate unless the total enterprise value of that business is vastly larger than the amount being borrowed.
Exactly. If that junior equity cushion isn't there, the lender is effectively taking on all the downside risk of an equity owner, but their upside is strictly capped at that modest 5 or 6% yield.
It is an asymmetrical, terrible risk-reward setup.
It sounds like common sense. You demand a cushion. But here is where the classic analysis exposes a terrifying danger.
What's the danger?
Depending on the jurisdiction, corporate law may legally allow a management team to intentionally, aggressively reduce its stated capital and distribute that vital cash cushion right back to the common stockholder.
Wait, after you've already made your loan?
After you've made the loan. Unless your specific bond indenture explicitly prevents it.
To truly grasp the mechanics of how this cushion can be legally stolen, we need to carefully walk through a very specific mathematical example provided in the text. Let's trace the numbers exactly.
Okay, let's do it.
Imagine a corporation starts with $2,100,000 of capital and surplus on its balance sheet. They decide they want to leverage up, so they borrow $2 million by issuing a 20-year, 5% debenture.
At the very beginning of this arrangement, the bondholders feel incredibly safe. They lend $2 million, but there is $2,100,000 of junior capital sitting right beneath them. The cushion is intact.
So the bondholders go to sleep, happy to collect their 5%. But over time, the business cycle turns. Operations slow down. The company isn't growing, but they still happen to have a large amount of extra cash sitting in the bank.
And this is where it gets shady.
The common stockholders look at this situation, call a meeting, and hold a vote. They legally vote to drastically reduce the stated capital of the company down to a mere $100,000.
And then what?
They then take that freed up $2 million and distribute it directly back to themselves as a massive cash payout.
Unbelievable. Let's examine the exact mathematical aftermath of that single maneuver. Economically, the common stockholders have just successfully recovered every single dollar of their original capital investment.
And they accomplish this by using the exact cash that was supplied by the bondholders.
Yes. But here is the critical part. The common stockholders still own 100% of the residual business, and they still retain 100% of the future upside potential above that 5% interest cost.
Meanwhile, look at the bondholders. They are trapped. They have effectively become the sole suppliers of capital to the entire enterprise.
Right. They are suddenly bearing virtually all of the downside risk of the business operating in a tough environment, but their upside is still strictly capped at a measly 5% ordinary interest return.
The massive junior cushion they relied on when they originally signed the contract was legally stolen right out from under them.
It is a profound structural unfairness. The junior equity cushion, which provided the entire mathematical and logical justification for making the loan in the first place, has been completely extracted.
Now, you might say, well, a brazen $2 million direct cash withdrawal like that is rare today.
It is rare in that exact form.
But the text emphasizes that the exact same economic effect is routinely achieved through subtle, sneaky accounting tricks. A company can suffer severe, legitimate operating losses that chew away at the cushion.
Right.
But then they can legally reduce their stated capital to simply erase that balance sheet deficit out of existence.
This is the danger of accounting resets. By magically eliminating that deficit on paper, the company instantly, legally permits itself to resume paying cash dividends to the common stock.
Long before those historical operating losses have been genuinely repaired by new, real earnings.
Exactly. The accounting trick violently reopens the door to distributions, even though the vital cushion protecting the senior holders is still severely weakened.
As an investor, you have to train yourself to ruthlessly separate accounting form from economic substance. If management votes to reduce the stated capital on a Tuesday, it doesn't miraculously fix the factory or improve the cash-generating power of the business on Wednesday.
No, the economic reality is identical, but it absolutely changes the legal reality of what cash is allowed to walk out the door and into the pockets of the common stockholders on Thursday.
The chain reaction is devastating for senior holders. If real operating losses have already eroded the junior cushion and management uses an accounting reset to permit new cash distributions, that future cash is leaving the company forever.
Right. It is walking out the door instead of being retained on the balance sheet to rebuild the lost margin of safety for the bondholders and preferred holders.
The historical mechanisms they used are fascinating to unpack. The text provides specific examples.
What kind of examples?
Well, you see companies changing their common stock designation from a no-par structure to a $1 par value. You see them actively writing down the stated value of their plant accounts or intangible assets. In one method highlighted, a company effectively transferred millions of dollars from its formal capital account over to its surplus account.
And another specific case I remember, a company aggressively reduced the par value of its preferred stock from $100 all the way down to $25.
Entirely to wipe out a capital deficit and legally clear the path for the resumption of dividends.
From the perspective of a bondholder sitting at the top of the stack, watching a company reduce the par value of the preferred stock beneath them from $100 to $25 is horrifying.
It completely destroys a massive portion of the margin of safety that they explicitly assumed would be maintained to protect their funded debt.
This highlights exactly why the specific wording of indenture protections is a matter of financial life and death. A well-drafted bond indenture isn't just boilerplate legal jargon, it is an active shield.
So what should a strong indenture look like?
A strong indenture must explicitly prohibit the payment of any dividends or distributions unless a highly specific, mathematically adequate margin of resources exists above the indebtedness.
For example, a robust structure might explicitly state that cash dividends can only ever be paid out of earned surplus.
Meaning actual generated operational profits, not just surplus created by an accounting reclassification.
Exactly. It might require that the net tangible assets of the company, calculated strictly after the proposed dividend is paid, must equal at least a specific hard percentage of the funded debt.
Or it might strictly restrict the company from retiring or acquiring its own stock unless the funds come from a specifically approved bucket.
That exact point about acquiring stock, the buyback loophole, is incredibly dangerous. Management can drain the junior capital cushion not just by mailing out quarterly dividend checks, but by aggressively repurchasing their own shares in the open market.
Yeah, that's a big one.
If your covenant strictly forbids the formal retirement of stock, but stays completely silent on the mere acquisition of stock, management has just found a massive loophole to drive a truck through.
Exactly right. If a company goes into the market and buys its own common shares or even repurchases its own preferred shares, hard cash is leaving the fortress.
Right, the money is gone.
The mathematical cushion sitting below the creditors shrinks dollar for dollar. Whether those purchased shares are formally retired and canceled by the corporate accountants or just held indefinitely in Treasury is vastly less important than the cold economic reality that the margin of safety has been extracted.
So, when you are building your checklist for analyzing these securities, you must demand that distributions are defined as broadly as humanly possible.
Yes, your net needs to be very tight.
It needs to catch dividends, open market buybacks, redemptions, returns of capital, and absolutely any other transaction that has the economic effect of draining the cushion.
Now let's explore how preferred stock, specifically, gets caught in a very unique, agonizing crossfire when these accounting resets happen. It places preferred holders in what the text refers to as an anomalous position.
It is a brutal trap based on an inherent conflict of interest.
How so?
On one hand, preferred holders desperately need that junior common equity cushion to stay robust to protect their principal. But on the other hand, if the company suffers operating losses and a massive deficit appears on the balance sheet, corporate law might step in and legally block all dividends, both common and preferred.
Right. Suddenly, the preferred holders who bought the security specifically for the predictable income are cut off. They want their cash to start flowing again.
And this is exactly the moment the common stockholders exploit the conflict. The common stockholders can approach the preferred holders and say, look, we are all stuck in this deficit together. Support our vote for a massive capital reduction.
It will magically erase the deficit and legally allow the company to start paying you your preferred dividends again.
Right, but there's a catch. Since we are engineering this fix for you, you need to surrender your claim to all your accumulated back dividends or accept a permanently lower dividend rate going forward.
It is an incredibly squeezed, coercive bargaining position. You are essentially being asked to weaken the very cushion you rely on to protect your principal just to regain the income you were originally promised.
It perfectly illustrates why preferred stock can be such an awkward, vulnerable asset. You hold the income expectations of a bondholder, but you lack the ironclad contractual rights to force a bankruptcy if you don't get paid.
You have technical seniority over the common stock, but your actual cash payouts are still highly dependent on the mechanics of corporate law and the strategic whims of a board that might be actively conspiring against you.
The conclusion we draw from Graham and Dodd's analysis is absolutely not that you should completely avoid preferred stock.
No, not at all.
The proper conclusion is that preferred stock must be analyzed with an unusual, almost paranoid level of structural care. You need both highly specific protective provisions and real enforceable voting power to survive this dynamic.
Having a great covenant without voting power is useless, and having voting power without strict covenants gives you nothing to enforce. You need both.
Because they do entirely different jobs. The specific provisions, the math, protect you against the known quantifiable dangers.
Like the issuance of new senior securities, the piling on of unsecured debt, the failure to maintain working capital, the skipping of sinking funds, and the buybacks that try to drain your cushion. Those are the known threats.
And the voting power protects you against the unknown situations, the massive, unpredictable crises that cannot be fully anticipated or legally drafted in advance.
When the company is fundamentally impaired, the specific class of investors whose capital is actively at risk must have a practical, usable mechanism to step into the boardroom and dictate policy.
And as the Maytag case burned into our minds, practical means practical. It cannot just be a theoretical right buried on page 40 of a dense legal filing.
It cannot be a vote that no one bothers to organize or fund. It has to be a functional mechanism that results in informed holders electing genuinely independent directors.
Let's pause for a moment and pull all of this deeply legal and historical analysis together. We need to connect this to the broader concept of capital allocation, turning this into a highly actionable framework for the modern, fundamentals-minded investor.
This requires a total redefinition of capital allocation. When we normally hear that phrase, we just think about how management reinvests profits, like should they build a new factory, acquire a competitor, or pay a special dividend.
But this analysis reveals that capital allocation is fundamentally about deciding whose money is actually exposed to risk. When we talk about the margin of safety, it isn't just about buying a stock at a low price-to-earnings multiple.
No, margin of safety actively includes the legal structure, the tightness of the covenants, and the physical reality of the governance.
Exactly. When a company decides to pay a massive special dividend while its creditors are mathematically underprotected, that is a capital allocation decision.
When management exploits a legal exception to issue a massive unsecured debenture that jumps ahead of the preferred holders, that is a capital allocation decision.
When they manipulate stated capital to restart distributions, they are reallocating risk. And when investors fail to read those terms, they often discover too late that their capital was vastly more exposed than the comforting label on the security suggested.
This is a monumental lesson if your strategy is to hold a security for 5, 10, or 20 years. The boring, tedious fine print in year one is going to matter vastly more than the flashy headline yield.
A sky-high dividend rate often acts like a magician's misdirection. It distracts your eyes while the weak protections quietly pick your pocket.
A slightly lower yield that comes bundled with ironclad covenants, superior asset coverage, and highly enforceable governance rights is almost always the superior investment over a full economic cycle.
Let's crystallize everything into a framework. If I'm an investor looking at a prospectus tomorrow, where do my eyes go first? We can build a 10-point checklist drawn directly from this text.
I would start right at the top of the stack. Number 1, I need to ask what securities can legally be issued ahead of me.
I'm reading the document to see if the terms explicitly restrict prior preferred stock. Do they restrict equal ranking preferred stock, secured debt, unsecured long-term debt.
Or did the lawyers write it to restrict one category while intentionally leaving a massive loophole for another?
Then number 2, you look at the day-to-day operations. Are ordinary borrowings clearly separated from structural debt?
We know the business needs working capital flexibility to survive, but a broad, lazy exception for the word debt can destroy your protection entirely. You have to look for specific maturity limits, hard dollar amount limits, and strict purpose limits on that operational borrowing.
Number 3, I'm looking for forced discipline. Is there a conditional sinking fund or a redemption mechanism?
And if there is, when is the company actually required to write the check? Is it based on a strict, unyielding percentage of the issue, like 3%? Or is it based on a highly fluctuating percentage of earnings?
Crucially, can it simply be skipped if dividends are unpaid, or if the board decides surplus profits are insufficient? The precise mechanical details determine if the fund actually has any value.
Number 4, you check the liquidity cushion. Is there a strict working capital or net current asset covenant?
And if that test fails, what actually happens in the real world? Are common dividends merely paused, or does hard, aggressive voting power shift directly to you? A covenant without a sharp, immediate remedy is highly unlikely to change management's behavior during a crisis.
Number 5, I dive into the voting rights. What exact voting rights appear when dividends are missed?
Do I have to wait for one missed payment, or am I locked in the trunk for 8 quarters? Do we get to elect a minority, a majority, or the full board?
Is the right share for share with the common stock? And if it is, I have to do the math. Is my preferred issue mathematically large enough for my vote to even matter against the ocean of common shares?
Number 6, if the issue is non-cumulative, the scrutiny must be even higher. Do non-cumulative preferred holders receive immediate protection?
They absolutely must, because a missed dividend is gone forever, their economic loss is permanent. Therefore, the logical case for immediate aggressive board representation is vastly stronger, not weaker.
Number 7, I look at the floorboards. Are there ironclad protections against reducing the stated capital or distributing that vital junior cushion?
I'm looking for strict limits on dividends, open market buybacks, redemptions, capital reductions, and those sneaky accounting resets that make distributions legally possible before real economic losses are genuinely repaired.
Number 8, you also verify the math on those limits. Are distributions strictly limited by earned surplus, tangible asset coverage, or a fixed mathematical relationship to funded debt?
The specific numbers matter. A requirement stating that net tangible assets must remain at least a specified percentage of funded debt is an actual physical wall. A vague promise of financial prudence is just smoke.
Number 9, then comes the Maytag question. Who actually enforces the rights?
Is there a designated trustee, a responsible issuing house, a depositary, a pre-organized holder committee?
Is there a practical, affordable mechanism to solicit proxies? If the holders are widely dispersed and passive and absolutely no one is legally or financially designated to act, the remedy might as well not exist.
And finally, number 10, if control does shift, are the new directors selected by the impaired class truly independent?
If the preferred holders finally gain the right to elect directors, those specific individuals cannot be closely tied to the common stock control group.
Ideally, they should have meaningful personal financial alignment with the specific class they are stepping into the boardroom to represent.
Now, running through that rigorous mental checklist might sound incredibly demanding. It sounds like hours of tedious work.
But that is entirely the point of fundamental investing. Graham and Dodd were not trying to make investors cynical about the capital markets. They were trying to make investors exact.
Because exactness is usually the only difference between a security that is merely called safe and a security that has the structural engineering to actually be safer.
Let's broaden the scope for a minute and explain why this specific analysis matters deeply, even if you never, ever plan to buy a single share of preferred stock in your entire life.
Yes, the application to common stock is huge. This entire lesson trains you in capital structure thinking. If you only buy common stock, you still desperately need to understand the exact nature and strictness of the senior claims sitting directly above you.
If you own corporate bonds, you must understand the exact thickness and vulnerability of the equity cushion sitting below you. You have to be able to look up and down the stack with clarity.
And if you are trying to analyze a business like a true long-term owner, reading these covenants gives you an unparalleled window into the fundamental character of the management team.
Does this specific management team treat the balance sheet with deep respect and prudence, or do they constantly use legal flexibility to relentlessly shift risk away from themselves and onto the senior capital providers?
A management team that deeply respects the capital hierarchy, that doesn't try to cheat the bondholders or squeeze the preferred holders during a recession, is usually a team that is vastly more trustworthy with your money over a 20-year horizon.
But a team that is constantly testing the absolute limits of their covenants, exploiting semantic loopholes and trying to quietly drain the cushion, they are showing you their true character. They are explicitly telling you exactly how they view outside capital.
We must remember this is not just ancient financial history from the 1920s. Modern companies today, right now, are constantly making capital allocation decisions that affect different claimants in wildly different ways.
Stock buybacks, special one-time dividends, corporate spin-offs, secured debt issuance, asset pledges, covenant-light financing structures, aggressive exchange offers. All of these modern maneuvers raise the exact same fundamental questions we've been discussing in this deep dive.
The names of the specific financial instruments might change. The financial engineering becomes more complex. But the underlying eternal question remains exactly the same.
Who is physically bearing the risk? Who is receiving the upside? And who actually controls the ultimate decision when the cushion starts to thin out?
Let's pull this into 3 big foundational principles to remember. Principle number 1, protection against being pushed down the stack.
Preferred stock absolutely needs strict, written restrictions against management dropping new senior securities or major debt, including massive unsecured debt in front of you. Remember, the economic reality of the cash flow drain matters vastly more than the legal label on the debt.
Principle number 2, governance rights must be real, timely, and actually usable. Having voting control shift to you after missed dividends, sinking fund failures, or working capital failures can be incredibly valuable.
But that is only true if the trigger timing is balanced, if the holders are capable of being organized, and if the newly elected directors actively and fiercely represent the impaired class.
Principle number 3, junior capital is the cushion. It is the absolute only thing that makes fixed value investing a rational choice.
If that vital cushion can be easily withdrawn by management through dividends, share buybacks, capital reductions, or accounting resets, you, as the senior holder, are suddenly being subjected to equity-like risk without getting anywhere near an equity-like return.
That phrase is the perfect summary of a disastrous investment. Equity-like risk without equity-like return. So many terrible fixed income or preferred stock blowups can be entirely understood through that exact lens.
The investor is sitting there, happily receiving a strictly capped, modest return, completely unaware that their downside risk is exponentially expanding every single day, because the underlying cushion is quietly disappearing, or the legal protections they thought they had are failing.
So the truly disciplined investor always asks, what could possibly go wrong here? And what does this specific document actually allow me to do when it goes wrong?
It's the quiet, unglamorous work of fundamental investing. Reading the fine print doesn't give you a hot stock tip to brag about at a dinner party. It doesn't predict the next quarter's earnings, but what it does is exponentially improve your judgment.
And judgment is what compounds over a lifetime of investing. Once you train your brain to truly see the capital stack, you will never look at a business the same way again.
You will automatically notice when a company's hidden leverage is quietly rising. You will notice when new, subtle layers of debt are being layered in right ahead of the older claims.
You will start to distinguish when share buybacks are being done from a genuine position of immense financial strength versus when they're being done from a position of weakness just to prop up a stock price while secretly draining the senior holder's cushion.
You will instantly notice when a preferred stock is being aggressively marketed to retail investors solely based on a flashy yield, while the underlying protections are dangerously paper-thin.
You will spot the covenant that sounds incredibly protective in the first sentence, but completely lacks an enforcement remedy in the second. You will realize when your safety depends far less on the actual economic quality of the business and far more on the fragile goodwill of a board of directors that was elected by someone else entirely.
And as a result, you become vastly less impressed by labels. You realize that the word preferred does not automatically mean protected.
The word secured does not automatically mean safe.
The word cumulative does not automatically mean collectible.
The existence of voting rights does not automatically mean you have any actual influence.
And looking at a balance sheet today does not automatically mean that the cushion you see will be preserved tomorrow when the company actually needs it.
I know that might sound incredibly cautious, almost pessimistic, but it is actually incredibly empowering. Because once you know exactly where the structural traps are hidden, you don't have to be afraid of the dark. You can just ask much better, much sharper questions.
Exactly. You start asking, if this company wants to issue more debt, do I get a vote? If they miss my dividends, do I get immediate board representation? If they skip the sinking fund, what exactly happens?
If working capital falls below the legal requirement, who actually gains control of the steering wheel? If stated capital is legally reduced, can cash walk out the business?
And perhaps the most important question of all, the ghost of the Maytag case. If the right is triggered, who's actually going to stand up and act? Not what does the charter say in theory, but what is practically going to happen in the physical room where the directors are chosen.
For long-term investors, this is the ultimate reminder to avoid blindly reaching for yield without completely understanding the underlying structure. A high preferred dividend can look incredibly attractive, especially in a low-yield macroeconomic environment.
It's tempting, for sure, but the yield is only one single line in a much larger, much more complex structural analysis.
A superior analysis demands that you ask whether the company can earn that dividend comfortably through the full, brutal, normal cycles of the economy, not just during the boom years. It asks whether the balance sheet is truly built to protect your specific claim.
It asks whether future debt can legally subordinate your position while you sleep, and it asks whether you and your fellow holders actually have the mechanical ability to respond if the payments suddenly stop.
And here is a crucial takeaway. When the answer to those structural questions is unclear, or when the covenants are flimsy, the margin of safety cannot come from the contract. It has to come from somewhere else.
It may need to come from a massively discounted purchase price, or from overwhelming, undeniable asset coverage, or, and this is vital, it might mean simply avoiding the security altogether.
Avoiding a security is a perfectly legitimate, highly successful investment decision. Graham and Dodd remind us of this constantly. As an investor, you are standing at the plate and there are no called strikes. You do not have to swing at every single pitch the market throws at you.
Let's spend a brief moment on the ethical dimension of all this, because it's deeply woven into the text. Why did Graham and Dodd, these titans of quantitative analysis, care so deeply about the wording of these qualitative provisions?
Because, at the end of the day, capital markets fundamentally depend on trust. When an investor buys a fixed-value security, they're making a profound compromise. They are intentionally accepting a strictly limited upside.
And in return for giving up that upside, they rightfully expect priority, they expect robust protection, and they expect fair treatment. If the company is allowed to just legally remove the cushion or brazenly ignore the voting rights when things go bad, that foundational bargain of the capital markets is completely undermined.
And that broken bargain has massive, real-world consequences for the cost of capital. If the broad market of investors begins to believe that protective covenants are weak or that they are unenforced in practice, those investors should rationally demand significantly higher returns to compensate for the hidden risk.
Or they should simply refuse to provide capital at all. And conversely, if companies actually want to attract patient, long-term capital, they should be eager to write terms that deeply respect the hierarchy of claims.
There is a profound lesson here for owner-operators, too. If you are running a business, the absolute cleanest, most legally aggressive capital structures are not always the smartest ones in the long run. Treating your capital providers with deep fairness and respecting the spirit of the covenants can dramatically lower your future financing costs and preserve your reputation in the market.
A company that aggressively protects its creditors and its preferred holders during the hard times is a company that earns enduring credibility. A company that hires lawyers to use every single loophole to drain the cushion might save a little cash today, but they will completely lose the market's trust tomorrow.
Now, before we close, let's translate this entire complex lesson into one simple, powerful mental model that you can use tomorrow. Imagine you are sitting at your desk looking at a prospectus, preparing to buy a preferred stock. The very first rule: do not start by looking at the dividend rate. Start by looking at the capital stack.
Ask yourself, what is sitting directly above me, what is sitting directly below me, and exactly what is legally allowed to change after my money clears.
Then, and only then, you move to the cash flow. You ask, can this specific business realistically pay this dividend through normal, painful economic cycles, not just during the good, easy years?
Then you move to the covenants. You ask, what specific actions is management explicitly prohibited from doing without getting my formal consent?
Then you move to the remedies. You ask, if the company breaks this economic bargain, what exact tangible power do I gain in response?
Then you move to enforcement. You ask the Maytag question. Who is actually going to organize the scattered holders and make that power real in the boardroom?
And finally, only after you've answered all of that do you move to the price. You ask, given all of those ironclad protections or given all of those terrifying weaknesses, what specific rate of return would genuinely compensate me for taking on this exact structural risk?
That exact order of operations matters immensely, because if you start with the yield, human nature takes over. You will start rationalizing the risks because you want the income. But if you strictly start with the structure, you force yourself to see the security clearly for exactly what it is.
And clarity cutting through the labels, ignoring the hype, seeing the exact mathematical and legal reality of the claim is the whole absolute purpose of this kind of rigorous analysis.
Which leads us to a final thought to really mull over. If we look at the modern market, we see massive, unprecedented amounts of money flowing blindly into passive ETFs and algorithmic index funds. Billions of dollars are automatically buying baskets of preferred stocks and corporate bonds every single day, completely irrespective of the covenants.
That is a terrifying thought. If the passive algorithms aren't reading the fine print and retail investors are just chasing the blended yield of the ETF, who is actually enforcing the discipline? If a company slowly drains the junior cushion or exploits a loophole to issue unsecured debt, the passive index fund isn't going to organize a proxy fight. It just holds the security until it defaults.
We might be building a massive vulnerability into the system where the Maytag problem of unenforced rights is amplified on a multi-billion-dollar scale.
That is exactly the kind of structural risk that a fundamental investor can exploit. When the broad market stops reading the documents, the advantage for the person who does read them becomes massive. The careful, disciplined analyst who understands these dynamics still holds the high ground.
And it is not an advantage that comes from predicting what the economy will do next quarter. It is a structural advantage that comes entirely from understanding the contract, understanding the balance sheet, and deeply understanding the incentives long before the trouble ever arrives.
Preferred stock is not made safe simply by its comforting name. It is made safer by clear, written restrictions on senior claims, by highly disciplined sinking funds and asset tests, by real enforceable voting power after impairment, and by maintaining an adequate, mathematically robust layer of junior capital that simply cannot be casually removed by management.
And even then, even with all of that in place, the investor must always remember the haunting lesson of the Maytag case. Protections must be actively exercised. A legal right that is not aggressively used by organized investors may turn out to be a safeguard that exists only on paper.
Capital Allocation Lab exists to make these classic foundational ideas completely usable again for long-term investors, for owner-operators, and for anyone who values clear, rigorous business analysis over fleeting market hype.
Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
What question did this raise for you? Have you ever analyzed a capital structure where the fine print changed the picture?
Please let us know what fundamental concept you want us to unpack next. Do you want us to look at margin of safety, owner's earnings, return on invested capital, or something else entirely?
Until next time, keep reading the documents carefully. Always think like an owner, and remember, the best protection is built before the crisis begins.